So welcome everyone to the webinar. Just a quick disclaimer is basically this is my opinion and general guide based on my experience. So I'm not a clinical psychologist. I don't have a CPA. I'm not an accountant of any form. So this is general advice and not suited to your individual circumstances. Surprise. Now, moving on, we're going to be covering Trading Psychology 101. Now, the reason that this webinar is so short compared to the other ones is because it's actually pretty straightforward. It's all about awareness and identifying where your weaknesses are and just being aware that they're even happening. And then just going through some strategies over how to actually deal with the psychological, the mental and emotional impacts. So that's really it, just about it really. So common psychological traps and practical solutions. So let's dive right into it. Now, a roulette wheel, for those of you who haven't gone to the casino, just has 18 black numbers and 18 red numbers and a 0, which is represented in green. Now, here's a quick question I want everyone to answer in the chat room. And that's, if the ball has landed on black 4 times in a row, what's the odds on the next spin that it's going to land on black? And ignore the fact that 0 is there. Ignore the green. Just let's pretend it's all black and red. What are the odds that on the next spin we're going to land on black? I don't care if you say more than 50%, less than 50%. I don't want you to go into too mathematical. Just give me a simple answer. Okay, you're all very smart and bright. Everyone said 50%. That's true. Now, gambler's fallacy is something that happens even though you know this as an answer. Believe it or not, here's an example. Here's an example of one that I used to trade on I think it was the DAX, the German index, because the German index, it's not 100%. The German index is a trend machine, kind of like oil as well. And what the gambler's fallacy does is it gives you a bias. It makes you believe in the position that you want it to go in. Being wrong is something that happens not wanting to be wrong is something that happens to people who are extremely competitive. Now, people who are extremely competitive are people likely to be in the markets. The markets and my YouTube channel are 98.5% male. They are almost exclusively in the 24 to 34 age bracket. And of course, men are more competitive in nature, and trading is as competitive as it gets. CFD trading, I think something like 85% of people don't make it. You tell a guy that if they've got 85% chance of not making it, they'll be like, hell yeah, I'm going to be the 15%. Women tend to have more common sense, I guess, and they just go, whoa, okay, that's probably not for me. But what happens with your bias is you'll want to go long in certain situations. And it dips again for a second time. Dips again for a third time. Surely it's going to reverse. Dips again fourth time. If you've ever looked at any YouTube video that explains the MACD indicator, you'd go, oh, that's oversold. Beautiful. You'd go long. That's 4 times it's dipped. 5 times it's dipped. 6 times it's dipped. There is no technical analysis here whatsoever to indicate at any point in time that it's reversing. But you'll want to be correct. You see the reversing happening, and you'll want to get in on that ride. Now what happens here, the thing with gambler's fallacy, ultimately is realizing, the solution to gambler's fallacy is realizing that the market doesn't have to do what you want to do. The market isn't bending to your will because you believe it should be long. And ultimately this comes down to your own mental state of wanting to be correct. And that's something that will get squashed and just repeatedly stomped on as you trade the markets. It's nothing new. Everyone goes through it, and you'll experience it at some point in time. So, another component or psychological trap that you go through is boredom. It depends on your personality, right? I'm a very introverted person, but I'm highly competitive. And you cannot put me in a room for 5 minutes. I have to do something. I can't sit there and listen to the radio. I have to engage in something. That's my personality, and actually that's my weakness, is that I'm aware of it actually. If I can't spot a trade in 15 seconds of looking at a chart, I'll go do something else. Because if I sit there looking at a chart long enough, you're going to do, or I'm going to do, what every other human is built to do. And that's look for a pattern. You're going to make sense of things that don't make sense. If you can't find anything from a technical perspective, from a charting perspective, in 15 seconds after looking at a stock or an index or whatever market you're trading, don't look at it anymore. Do something else. And that's my method of countering boredom. I'll play a game. I'll go do the dishes. I'll vacuum. I'll do whatever it takes, because I know the longer I sit there, after about 5 minutes, I'll itch for a trade. I'll have to engage. I'll have to do something with my hands. So that's something that I'm very aware of for myself, and it's something that you should be aware of if you're that personality type. If you're a person that can pick up a book and sit in a corner for 3 hours at a time, then you're going to have such a good time trading. So you got to realize that cash is also a position. The thing with boredom is it's not just that it's not interesting at times. It's you get an itch to trade because you've spent the last, let's say, 2 hours of your trading day, or maybe you've spent 2 days looking for a trade because maybe you're more of a short-term to mid-term swing trader. You're looking for that position and you're itching for a trade because guess what? Your capital is sitting there waiting and it's not making money. It's not doing anything for you. That is one of the worst mentalities to have. Cash is a position. Being long or being short, fair enough, but cash is also a position. So it's 3 positions on the market. You've got to be aware of that. And ultimately, you've got to reward yourself for not taking trades. It may sound silly, it may sound almost childish, but I strongly recommend that you reward yourself. Whatever it is, whatever your simple life pleasures is, just best if it's not food. You'll get fat very quickly. So pass to the next one. So FOMO. So this is one that a few people have mentioned and specifically talked about. And really, it's just the fear of missing out. It's seeing a trade go in the direction that you were intending it to go, but maybe like if you saw my last webinar on technical analysis, 85% of the time, a breakdown will come back to retest the trend, and then it'll continue on the way down. 15% of the time, and that's just an approximate estimation of the likelihood of it happening, about 15% of the time, it'll just break through and never come back to retest. So when that happens, you get this urge that you must enter. And we've gone over this in my TA scalping webinar, is if you enter a position, let's say if I bring up, you enter a position somewhere around here, instead of somewhere up here, your risk to reward goes down significantly. Your stop loss will be just here in both positions. Doesn't matter where it is. Above the trend line will be your stop loss. That's just simple, basic technical analysis of trend line trading. So you can see the gap between what you're risking. That could be the difference between $10 stop loss and $60 stop. There's a huge difference. And then, of course, your take profit target, wherever that may be, is significantly reduced. Your risk to reward is also reduced. So when it comes to FOMO, a lot of it comes down to other people's influence. If you're trading stocks short term, if you're someone that uses hot copper, and I know a lot of you do, hot copper is the most charged environment you could possibly be in. It is one of the most unhealthiest places to be in from a psychological perspective. When you start out trading, and when I say start out, I mean in your first year of trading, you're going to experience people talking about a stock that's running. They're going to convince you that they're in the stock already, and they may very well be. But once a stock runs and they talk about it, it's too late. So stay away from social media as one of the solutions. And you don't have to permanently do it, just temporarily. If you find yourself getting FOMO, stay away from Twitter, stay away from Hot Copper, Reddit, or Facebook, wherever you get your source of information from. Because if you can't trade without social media, you need a real serious check, a reality check on what you're doing. You either don't know enough technical analysis or you don't know enough fundamental analysis. It's one of those two, or maybe both. When you start out trading, you want to find a community that can help you. But ultimately, these communities are almost entirely self-interest. Don't get me wrong, there are some people out there that have genuine interest in helping other people out. But it's not common, especially in the small cap world, which is something that my YouTube channel focuses quite heavily on. It's teaching you to be self-reliant. Now, if you're not self-reliant, of course you're going to take the opinion of other people. Do you know how many people saw my call for entering something like, what was it, Afterpay at $10? I think it was $10.20 with a stop loss of $9.50 and calling that it was going to hit $17. You know how many people saw that trade and thought it was ridiculous? Even I thought it was ridiculous. But what I feel about the trade doesn't matter. I've got the technical analysis, the fundamental analysis, and that backs it up. How I feel about a trade doesn't matter. And you'll experience that in the future as well. So I'll talk about that a bit later. So analyze your trading plan. And my question really to everyone in chat is, do you have a trading plan? Yes or no? Quick. Get on the keyboard. Do you have a trading plan? I don't care how simple it is. Do you have any kind of trading plan? YOLO, no, yes, no. So we can in the Q&A we can talk a bit about trading plans and what you might want to put into it. But if you don't have a plan for your trades, you're going to experience FOMO. You won't know how to enter positions appropriately. And this is going to be particularly useful for the 30% of you that said no. So what happens when you do FOMO is you'll take up more positions. You'll get bad entries, as I already discussed, and your risk to reward will go down the drain. And you'll trade larger positions to make up for it. So there's absolutely no reason that FOMO should ever be in your repertoire of things to do. Now, it all comes down to awareness and knowing that you're doing it. But we'll talk about that a little bit later as well. The other thing is revenge trading. This is all about increasing your trading frequency when you've got it wrong. So if we go back to this example here, let's say you've got stopped out 1, 2, 3, 4, 5, 6 times. Sorry, that's 5 times. And on the 6th time, you finally got it right. You're going to revenge trade the hell out of that to make up for all these losses that you've done. Revenge trading is part of the ego that we're talking about that a lot of us have, especially us highly competitive people. What you'll do is you'll increase your position sizing, you'll increase your frequency, you'll basically do everything you shouldn't. And we've talked about frequency before, especially for technical analysis trading. You want to minimize the amount of trades you get, not maximize. You don't want to scalp as often as possible. You want to scalp as little as possible with the best risk to reward and highest probability. Now, if that's part of your trading plan, revenge trading is obviously not going to fit anywhere near that. Your revenge trading will have a short-term focus because you're going to be emotionally charged. You'll want to reverse the damage that you've done to your portfolio straight away. Now, and this comes back to trading in the wrong direction. So if you start doing revenge trading, you're going to stick to your bias, that initial bias that we had, your position bias. If you get stopped out, you're going to be like, oh, well, it's going to turn around now. That comes back to confirmation bias that we already discussed. So the solution to this particular psychological trap is focusing on the long term. So if you ever find yourself revenge trading or wanting to revenge trade, just keep in mind that it's not all about today. If you want to make money every day, trading's not for you. If you want to make money every week, trading's not for you. Trading is not a guarantee. It is, it's not your 9-to-5 job. You're not going to make $500 every day, every week, consistently. Losing is going to be it's just an essential part of trading. And you've got to realize that a losing trade is not a bad trade or a wrong trade. Let's say we got our initial bounce here that we got wrong. Maybe there's some technical analysis that says that this is a good bouncing target. Let's say there might be some historical trend lines. If you got a nice reasonable stop loss target for that, That's not a wrong trade. If you lost money, it doesn't make it wrong. What makes it wrong is you trying to catch the bottom every single time when there's no reason to. When there's no technical analysis, nothing to support what you're doing. No fundamentals, no technicals, no nothing. It's just you wanting to pick the bottom. That's the wrong way to trade. So we'll get into the practical solutions. It's one thing to be aware, but the practical solution really starts from being consciously aware of what you're doing. So it's easy to say, oh, I suffered from FOMO. But what are you doing about it? Are you just going to do it again? You're just going to tell yourself, maybe I shouldn't FOMO next time. Is that going to solve your FOMO? It's not. So when you start being consciously aware of what's happening every trade, your state of mind before every trade, getting stopped out will feel more familiar than it is threatening. Getting stopped out is a part of trading. Taking losses is a part of trading. This comes back to when I mentioned that a losing trade is not a bad trade. You can have two people with the exact same trade in opposite directions. One will make money and one won't make money. Just because the person who made money doesn't mean that they're the one that did the correct trade. It's possible that they got lucky. It's possible that the statistics weren't on their side. And that's what luck is. When statistics aren't on your side, then you got lucky. If you made profit on a low probability or low statistical chance, then you got lucky. And that's a bad trade. I mean, don't get me wrong, it's better than losing money, but it's not a correct way to trade. In the long term, you'll lose out. Now, technical analysis is based on statistics, not probability. So once you're aware of this, you'll have a better state of mind in terms of taking losses. Now, statistics and probability kind of get muddled up a little bit. When someone tells you technical analysis doesn't work, that's because they believe it's probability. Now, probability is saying that something will happen after a given amount of time. Let's say, for example, what are the odds? So you've got, let's say, a questionnaire, and you're taking an exam back at school, back in university. You've got a multiple choice, A, B, C, D, and E. So you've got 4 choices. The probability that you'll choose the correct one is 25%. It's 1 in 4. Statistically, B is the answer. I think it's something like 45% of the time or 40% of the time it's the correct answer, just because of the way people set up the structure of the exam. Statistics is, if we say 1 in 6 million flights will end up in a casualty, so I'm talking about airline flights, so you take a Qantas flight to wherever, statistically 1 in 6 million might crash. Probably not Qantas, that's a bad example because I don't think they've ever had a fatality. Let's say Virgin, 1 in 6 mil. Now, if you're on the 6 millionth flight, that's not a problem. You're not guaranteed to crash, right? That's the difference. So probability looks at the future. Statistics looks at the past. Statistics will see what has happened in a particular trend setup with particular fundamentals, and will give you a statistical likelihood. We've covered that in the technical analysis space in the last webinar. And we don't go through the exact numbers. We don't say, oh, this setup has 60% likelihood of being successful. But we know which ones are more than 50-50. And those are the ones that are going to end up profitable in the long term. Anything better than 50-50 is going to be profitable. So once you get comfortable with being aware of your psychological state, you won't be so averse to losses. Like I said before, it'll feel familiar. And the more familiar you are with losses, the better it'll be. And this is why I focus so heavily on risk aversion. If you've seen any of my videos, even if you've just seen one, I very heavily focus on risk. Because we're risk managers, that's what we do. We want to minimize losses because losing is the hardest part. Winning's easy. Set up a trade and off it goes. Let it go. You got a losing trade, you're going to have 100 different things running through here. My account size is dropping. Oh, it's another loss. That's my 3rd one in a row. Oh, shit. Where am I going to get stopped out? Should I tighten my stop loss? Should I widen them? You don't start adhering to your own plan. So the actual practical solution to change. Now, this is probably the most important part. You can't change if you're not aware of it. Now, I see a lot of you are aware of things like FOMO. I had someone messaging me today, it was yesterday, telling me that they lost, I think it was $7.5 grand for the week. $7.5 grand. So you can imagine the mental state there of losing that much money. Even I would feel sick if I lost $7.5 grand. You can imagine the mental state there. And they're aware that psychology is the reason that they lost that money. They didn't trade properly. They held onto a losing trade. And that was it. You're suddenly down $7.5 grand. So this is the part people don't like to hear, because it's the part that means you have to do work. Dedicate time to identifying habit patterns every day. You're aware of the psychological traps. You know what's there. You know what revenge trading looks like. You know what the gambler's fallacy looks like. You know about position bias, about long bias or short bias based on your historical losses or trades. You're aware of these things. So identify the habit of when you're doing them. Because if you're not aware, how are you going to change? Now, a big part of psychology, at least managing the mental and emotional aspect, is studying yourself. So you need to be aware. You need to observe your patterns, because patterns are what make habit. If you have terrible habits, you're going to have terrible trades. If you've got the same habit and you keep executing with that same habit, and you've got a losing habit, what's going to change? Nothing's going to change. So I'm sorry, at the end of the day, you're going to have to put in the time to analyze your trades. You're going to have to go back, you're going to have to look and see what went wrong. And not just from, oh, that was a bad entry, identify why that bad entry was made. You should remember on that same day why you made that trade. You won't forget. You'll know why. Is it because someone on Hot Copper told you to buy? Is that why? Did you get the FOMO? Did you see a chart pattern running away? It's easy in hindsight when we look at charts and go, oh, I wouldn't do that. I wouldn't FOMO into that. But when you're live and you're looking at a trade and it's going further and further away from the second you looked at it, you're going to get FOMO. Even I get FOMO. It's human nature. You want that trade. So you need to be consciously aware of what you're succumbing to effectively. And the single best thing I've ever read when it comes to changing and, I guess, practical solutions to changing your psychological behavior is by Brett Steenbarger. He's a very, I guess, world-renowned psychologist for traders, for hedge fund managers. People literally executing hundreds of millions of dollars at the click of a mouse. Now, the only thing that I've really taken away from any psychological book, any book on psychology rather, is the ABCD process. And that's adapting to the market. So success is never static. The market does change. If you want evidence of that, look at this year. What's happened to every single goddamn stock on the market? Every large cap is trading like a small cap. Are you going to start trading large caps like they're large caps from last year? No, of course not. Of course not. I'm trading large caps like they're small caps, and I'm loving it. Adapting to the change and identifying that things are different. These days, I don't trade that often. I wait for the opportunity. And when the opportunity presents itself, I know it's going to make big returns. At Afterpay, Qantas, albeit Qantas was a loss, even South 32, a stock like South 32 can still yield 20% returns in just a couple of days. These are powerhouse stocks that never in any other circumstances would provide these kind of returns. So adapt to the markets. Why would you trade micro caps right now? Hands in the air in chat box. Who's still trading micro caps? And the follow-up question is, who's still trading micro caps and making money? Unfortunately, there's not too many people on at the moment. There's only a handful of answers. Yes, yes, thumbs down, and yes. Probably slightly better than break even. Yeah. So adapt to the market. Now, so those of you who are trading small caps, how many of you have traded a large cap or a mid cap stock in the last 2 weeks? Yeah, there you go. Been trend trading mid caps, as you should. So that one's pretty obvious, is adapting to markets. Now the other one, the less obvious one, is building strengths. Now every single person, at least ones that I've spoken to, have at least one major strength. I have 2. Mine is the ability to look at a financial document real quick and determine the value of a company. It's not that every financial document's the same. It's that I'm able to process, because you can see the subcategories that we've gone through. Every financial document's different. The headings are the same. Your total assets, that heading is going to be there. Your total liabilities, that's going to be there. And your total equity is going to be there. It's about understanding what's in between those and understanding the value of a company and seeing where there's huge red flags. To me, I can identify that in a couple of minutes. I can read through a whole document, pick apart what's essential, and I can value a company. And that's why I was so good at trading microcaps. I was able to value a company and know where it was going. And my other strength was picking falling knives, basically. So catching falling knives. That was something that I was successful at from day one. Can't tell you why. I just didn't care about. I just didn't have a fear of losing money. To me, it was a bit of a thrill. So it comes back to that weakness that I had of not being able to sit still. And when I saw a falling knife, I could trade that day in, day out. In fact, I look forward to falling knives because I have such an incredible success rate at spotting market turnarounds in a very short period of time. So everyone here has strengths. Build on it. If you have a weakness, don't assume that you can turn that into a strength. It's not a Disney film. We're not in a Disney film. You can't just study and practice on your weaknesses and turn it to a strength. It's not going to happen. It's just not. If you suck at short-term trading, it's likely something to do with your personality. Stick to mid-term or long-term trading if that suits you better. Why would you put so much effort into something you suck at? Yeah, you might marginally improve, but that's still going to be your weakness. Now, cultivating creativity is an interesting one. It helps adapt to markets for the strategies that you already have. Now, here's an example of one. VWAPs aren't that great at the moment. And I'm talking for specifically Forex markets. They just suck at the moment. They used to be the absolute gold standard. You used to be able to trade with 2 pips stop loss on something like Aussie yen. And now it just shoots up and down like it's nothing. It doesn't respect the VWAP at all at the moment. High volatility times, don't trade it anymore. So use the VWAP to identify trend movements and scale in on positions rather than relying on a single heavy position to reject off it. Same thing for the Hong Kong market. I used to trade the Hong Kong market like almost every morning. I loved it. It respected VWAP, it respected trend lines, and now it crashes through them like a goddamn psycho. So I can't trade that anymore. I can't trade it the same way anymore. So I just adapt my style. I simply scale in on positions. Now, just because it doesn't respect trend lines anymore, doesn't mean I just stop trading it. It means I just scale in once it breaks the trend and watch for the reversal. So it's about adapting the strategies that you already use. I don't stop using VWAP, I just adapt how I use the VWAP. I don't stop using trend lines, I just adapt how I use my trend lines. Now, developing best practices is the final part of this ABCD process by Brett Steenbarger. And that's effectively trying to learn as much as you can about what is best practice for risk management. Best practice right now is 1%. That's standard across the board. Doesn't matter where you go, every professional will tell you 1% is the best risk management strategy. Now, it's up to you whether you apply it, up to you whether you take 1-to-1, 1-to-2 risk reward, depending on your capital size and what you're trading. It's up to you to manage your position sizing and manage your actual capital. Now, developing best practices is actually about keeping them as well. This is where you develop your trading plan. This is how you manage your mental state. If you don't have a trading plan that you adhere to, you know what's going to happen is you're going to fall to emotions. You're going to fall to your psychological state of mind of wanting to chase that trade, wanting to enter that position, wanting to move your stop loss just a little bit higher. Maybe something's gone in your favor, but you move the stop loss up into profit, but it hasn't moved up enough to justify it. You know, so it's up to you to really manage what is best practice and use that as part of your trading plan. Now, habit through repetition is essential, not the need for motivation. And I think that is the absolute best way to end this webinar, is you can't just get motivated and just expect results. You can't just watch this webinar and just be like, wow, I feel motivated to really just control my next trade and just be really aware. Motivation doesn't work. Motivation gets the initial kick going, but motivation wears off within a day. How many of you have been motivated to go to the gym? You feel, hell yeah, I'm going to work out today. What about the next day and the day after that and the day after that? No, you're motivated for the one time. Motivation works for a very short amount of time. It's all about developing habit. So one of my personal habits that I do every single time is exercise. I know it sounds a bit cheesy, but the best way to manage your mental state is through exercise. I learned that very early on. When I was stressed trading, I was over trading in large parcels, and I would be stressed out. If I lost $1,000 in one day, that would stress me the hell out. I learned very quickly that going to the gym, picking up weights, would basically just be a huge reset button. Now, I didn't feel motivated to go every day. In fact, I run every second day for the last 4 years, I think. 3 or 4 years. I run every second day, unless there's extreme weather conditions. It's not because I want to. I didn't want to go today. I didn't want to go the day before or the last time I ran. I almost never want to go. It's just a habit. I do it because I need to. I do it because for me personally, I don't know what you're like, but for me personally, I need exercise to trade. This doesn't stay very clean and clear when I trade. When I execute large positions and it goes against me, every big loss hurts, and it will hurt. All right, it's expected. Don't get me wrong. It's expected to that I'll lose, but it does affect me, and it always will affect me because I love money. Who doesn't? But for me, working out or running in my case, just doing 10Ks or doing 6Ks, doesn't matter what it is, I do something, and that's my reset. And that's a habit that I've formed for a very long time now. Not motivation. I'm never motivated to go. I just know that I need to do it. The same way you know you need a shower every day, the same way you know you need to brush your teeth. None of us enjoy these things particularly, but it's a habit. If you continuously do this, I think it was Tony Robbins that said, if you do something for 30 days consistently, then it will become habit.